Is this the top? Is it the bottom? How far can it fall? Should I buy it, sell it? What is a Fed rate cut? How does that affect me? Should I dollar cost average? Oh. The question I'm being asked most often is how low can this market go? Here's the answer. Hi, and welcome to another video. This is Adrian from Margin Call. In this video, I'll answer the question, how should you be thinking about your investments given all the coronavirus panic? There is so much scary news out there because fear sells well. Let me give you the summary of this past week. Schools in Japan are closing for 1 month. There's a rumor that the White House acting chief of staff announced potential school closure due to coronavirus. People from a few countries are not allowed to come to the US. United is not flying to Korea or Japan and other regions affected by the virus. There's a boat close to San Francisco where a lot of people are infected. San Francisco declares state of emergency, but also New York recently. Italy's closed for business. France is scared. Bali doesn't accept any flights from China. Iran's vice president has managed to catch the virus. In China, the virus rate has slowed, but outside it's still increasing. So what we already know is that viruses, they come in waves. So maybe this is the first wave, then it's going to cool off a little bit, and you get a second wave, and so on. Cruises, resorts, they all sold off this week. So maybe you're wondering, what's our situation right now? Well, what's an investor to do in these crazy times? So I'm going to go over both scenarios, market drop and market recovery. First, I want to talk really about something you probably don't know about, or maybe you do, the scandal behind coronavirus. So reports of coronavirus came out as early as November 2019, November. But unfortunately, many of those reports seem to have been deleted now, conveniently. China, in fact, alerted World Health Organization about several unusual pneumonia cases in December last year, 2019. But only in January, coronavirus was identified. And a few days later, on January 11, 2020, this year, the first death in China from coronavirus was announced. We're now in March. So far in the US, only a tiny fraction of the people who should have been tested have been tested. The problem is they didn't have test kits. Then the policy on who should be tested has been very restrictive. So this is mostly an issue of policy and execution. Now the policy is being changed and more people are going to be tested. Let me show you.
We're ramping up testing.
When will the tests become widely available is anybody's guess. So far, investors have been driven by the number of reported cases. As we're able to test more people, it's quite probable that the number will increase. And a vaccine is far away.
Well, there will be more cases, there's no question.
So now let's talk about a bear scenario. In addition to what I already mentioned, you can make the argument that stock markets all over the world have been, I don't like using this word, but propped up by central banks by keeping interest rates low for years. And the stock market's been going up, not because of higher earnings really, but not because the economy is getting any better, and not because valuations are low either. So really all the buying in the market is happening just because it's been going up. So it's momentum. Buying begets more buying. At this point, we have RSI divergence on a chart. So let me explain what this means. As markets rose, internal momentum is not keeping up. And speaking of RSI, we're still not oversold, even after this big drop in the market. This means that a market can fall further before any natural buying that occurs when something is oversold. So this is pretty negative for a long-term perspective. Also, we have low volume in the rally, which means lack of conviction. On a positive note, Trump is the biggest fan of the markets. Whether you like him or not, you have to admit it. He will most likely do all that he can to not allow it to crash, maybe even force the Fed to lower rates, which would happen now. The Feds did lower the rates by 50 basis points. Some say the expectations were 100 basis points. Just let that sink in. Like I said in the last video, the Feds would have to lower the rates, which happened now. So the expectation right now is that they will lower the rates again in March. The scary thing with that is soon the rates are going to be zero and there's not much you can do about it. My next point is that stocks are trading at a discount right now, but investors have all this fear. So how should you deal with fear? You can think about it this way. Day follows night and night follows day. You following me? I know it's a difficult concept. So when day comes after night, are you scared? Oh no, it was night, what's a slight thing? Eventually you get used to light, but night follows it. When that happens, you get scared again. What's this darkness? Where did all the light go? No. So in the same fashion, you expect markets to go up and down, kind of day and night. You can't be surprised when the market is down. If you are, it's called recency bias. It means you have short memory. Obviously, certain companies are affected by coronavirus more than others. If you're familiar with the history of the market, you know overall it's going up, and every now and then you have a buying opportunity. You can think of this week as your buying opportunity. So what am I doing? I'm watching market leaders, as I mentioned before, semiconductors, and the FANGs. I'm buying small in my support zones. If you don't remember those, let me put them in again there. I think the earnings season will not go well, but that's already baked into the current price. On Monday, March 3rd, the market bounced, but most of it was short covering. I closed my hedge at the time, my short position. Remember what Buffett said last week, don't buy or sell on the headlines. Keep your emotions in check. And anything can happen to stock prices tomorrow. Occasionally, there will be major drops in the markets, perhaps 50% of magnitude or greater. He said 50%. He continues that a combination of what he calls the American tailwind and compounding wonders will make equities a much better long-term choice for the person who doesn't use borrow money and who can control their emotions. So if you're not comfortable with your allocation, now is a good time to revisit it. Maybe you want to increase your exposure to long-term treasuries. Do you have an emergency cash fund? Maybe you should start one. And speaking of treasuries, let me show you what happened this week. So it was cheaper by 50 basis points to borrow money. Can you guess why bonds go up when they pay less interest? Let me know in the comments below, and I'll explain it in another video. On a fundamental basis, the stock market is still significantly undervalued when you compare to the 1% yield on the 10-year treasury note. However, if it was not for the Fed's money printing, I could confidently say that the market top is in, and we won't be seeing a new high in a long time. However, if you think about the 1% yield on a 10-year treasury note, that's equivalent to a P of 100. In comparison, the market PE right now is 20, which seems pretty cheap if you look at it in this context and compare it to the P of 100. So I mentioned this before. The Fed seems on track to lower rates and print more money. This will just make stocks even more attractive. So the question I'm being asked the most is how low can the stock market go? And I don't have an answer.
Just kidding.
I think you should look at the chart of the S&P to get a long-term perspective. So this is the weekly chart. Notice the huge sell-off volume in the last 2 weeks right here. It's about 3 times larger. I think if the market makes a new low, so the current low is right here, 286-ish, 285 perhaps. If we make a new low, the algos are going to start hunting stops, which means it will drop even further really fast as all the stops get taken out. Now, usually after that moment, there's a bounce, a rally starts. So that can happen, but only if there's no new bad news regarding Corona. Now, if, and only if, we dip below 274. I'm looking for the market to fall to around 230-ish, which is this level right here. That's where the next support is. And I said this before, just because the market dropped right now, it doesn't mean you should buy. You need to look at the signs. So these are some of the signs, in addition to looking at market leaders and the FANGs. This week, the G7 countries issued a statement that they want to lower interest rates even more and do more money printing and more borrowing. Yay, money, 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 money. Oh, wait, I'm not a bank, but I could refinance my mortgage if I had one, or I could buy some long-term treasury bonds to get ready for the next rate cut. Also this week, Malaysia and Australia lowered interest rates. So watch out for more statements like that from various central banks. Maybe Canada's next. This was my review. I hope it was useful to you guys. Like it if you like it. Dislike it if you hate it. Subscribe. See ya.